So, hello everyone, and welcome to the 11th edition of our Commodity in Focus webinar series. My name is Nishita Sharma, and I will be your host for today's webinar. I'm based in India, and I'm currently working as senior specialist with the commodity intelligence and the price forecasting team here at the SmartCube Procurement. I have been in the commodity space for more than 8 years now, and my responsibilities include working with a diverse set of clients to understand their requirements or challenges with respect to commodities intelligence, inflation, risk management, and translate them into actionable solutions to meet their requirements. Joining me today are our valued panelists, Anuj Madaan, Vivek Aggarwal, and Garvit Gupta. Each brings a wealth of knowledge and expertise in the commodity space, and today will take us through a comprehensive analysis of how some of the key global events are expected to shape up the commodity markets in 2025, with focus on metals and crude oil. From an agenda standpoint, today's session is important as we talk about some of the key global events and their detailed impact on the metals and the crude oil prices in 2025. At the onset, we will explore details about some of the key events to watch out for in 2025. This includes monetary policy stance by the central banks and how rapidly the market expects the decrease in the interest rates next year. We will also look at China's economic outlook and the possible impact of the recent stimulus packages. We will then focus on the growing geopolitical risk in the commodities market, including the concerns about the disruption to supply chains in the Middle East, and finally, the outcome of the US presidential elections to be held in November this year, and how the domestic and the foreign policies may look based on who is elected as the next US president. Following the understanding and different scenarios of these events, our experts today will walk you through the impact of these events on base metals, precious metals, and the crude oil market. As we progress through these topics, I encourage you all to engage actively by posting your questions in the Q&A box, which you can find at the bottom of your screen. You can also upvote questions that resonate with you. We will also leave some time towards the end of our session to answer all these questions. Okay, so without any delay, let's begin with our first topic in the agenda. So over to you, Anuj.
Thanks, Nishita. In 2025, both the US and Eurozone are projected to experience a gradual decline in inflation, reflecting successful efforts to stabilize price levels after periods of elevated inflation rates. In the US, the Fed policy tightening has helped moderate consumer prices, with inflation expected to align closer to the 2% target. Similarly, the European Central Bank has seen inflation begin to recede, though it continues to address varying inflationary pressures across member nations. This trend allows both central banks to consider more accommodative monetary policies without risking economic instability. In September, the US Federal Reserve implemented a rate cut, signaling a shift towards a more accommodative stance as inflation showed signs of moderation. The Federal Reserve projects a gradual reduction in the federal fund rates, signaling a cautious approach rather than aggressive cuts. The Fed's strategy stems from managing inflation while ensuring steady economic growth. One of the key indicators guiding these decisions is the US unemployment rate, which is projected to be around 4.4% in 2025. Despite previous rate hikes, the labor market has remained resilient, which indicates strong economic fundamentals. Unlike historical patterns where high rates would drive up unemployment, current conditions show lower joblessness. This reduces pressure on the Fed to implement steep rate cuts, suggesting a gradual path to avoid overheating the economy. The ECB is also expected to lower rates, though their path may differ due to unique economic challenges. Moving on to the next slide, in this chart, we have shown the probability of rate cut at each of the US Feds meeting on the left axis and the mean effective Fed rates on the right axis. The Fed's median projection of a 3.4% effective rate by the end of 2025 suggests caution, aiming to ensure sustainable economic momentum without triggering a sharp increase in inflation. It's crucial to understand that while rate cuts are expected, they will likely be measured, reflecting the Fed's approach to avoid potential market volatility and to maintain stability. Lastly, any global economic shocks, geopolitical events, or unexpected inflationary pressures could alter this outlook, which is why continuous monitoring will be essential as we move into 2025. Next, we will discuss another important event that can have significant impact on the commodity markets, the US presidential elections. I will be covering three potential scenarios from the upcoming US presidential elections and their implications on economic policies and global markets. Each scenario can have significant impacts, and understanding them is the key to forecast market trends and strategic shifts. In the first scenario, if Trump wins decisively, we can expect substantial tax cuts and deregulation, continuing his previous approach. Higher tariffs, particularly on China, would likely be a priority, aiming to boost US exports. The tariffs could add up to $60 billion annually in trade costs, increasing pressure on global supply chains. Reduced involvement in international conflicts would also be part of this scenario, focusing more on national interests. Additionally, with the robust domestic policy, higher interest rates would persist to curb inflation. In the second scenario, a divided Congress under Trump would mean limited tax reform and only partial deregulation. Trade policies would remain protectionist but more balanced with moderate tariffs. Past policies has led to a 25% increase in tariffs on key commodities such as aluminium and steel. The economic policies would be marked by caution, with moderate rate hikes reflecting fiscal uncertainty. The Federal Reserve approach could align more with the need for economic stability rather than aggressive tightening. Whereas under the President Harris, a shift towards higher corporate tax and green initiatives would define domestic policy aiming for environmental sustainability. There would be incentives for implementing stricter environmental standards promoting clean energy solutions. For instance, the proposed green policies could lead to a $200 billion investment in clean infrastructure over the next decade. The foreign policy would emphasize international cooperation, strengthening multilateral agreements. Additionally, the Federal Reserve might adopt a more relaxed stance on monetary policy, promoting growth through lower rates to encourage investments and job creation. These scenarios highlight possible shifts in US domestic trade and foreign policies affecting everything from inflation and interest rates to global supply chains and commodity prices. Understanding these dynamics will be crucial for navigating the economic landscape in the coming years. Next, I will address the recent trends indicating a slowdown in China's GDP growth rate, which could have significant impact on commodity markets. As you can see, the China's GDP growth has slowed significantly over the past few quarters. This trend is reflective of both domestic and international challenges, including reduced consumer spending, a sluggish real estate sector, and external pressure on exports. The real estate sector, a crucial component of China's economy, has seen a sharp decline. The investment in real estate sector has dropped considerably as indicated by the light green line on the left chart due to issues related to debt and credit in the broader economy. This sector alone contributes nearly 30% to China's GDP. China's consumer sentiment index has shown fluctuations with recent dip reflecting weak consumer confidence. This indicates lower household spending impacting domestic demand, which has been a key driver of China's growth. The PMI index has also struggled to maintain momentum, reflecting slower industrial demand. These indicators collectively highlight a broader economic slowdown leading to weaker demand for commodities, raw materials, and industrial goods. Domestically, the Chinese government has initiated stimulus measures to stabilize growth, but their impact has been limited, especially with the continued concerns in the real estate sector and ongoing efforts to control financial risk. Moving on, let's deep dive into the recent monetary measures that China has introduced to stabilize its economy. The People Bank of China has implemented significant monetary easing, marking the most aggressive measures since the pandemic. The central bank has reduced the reserve requirement ratio by 0.5 percentage points, injecting more liquidity into the banking system to encourage banks to extend credit to businesses and consumers. The 7-day reserve repo rate was lowered by 0.2 percentage point to 1.5%, decreasing short-term borrowing cost. Additionally, a broader 0.5 percentage point cut in average interest rates reflects a strategic attempt to lower the cost of capital, which can help revive consumer spending and private sector investments. However, additional fiscal reforms will be required for local debt management and to bolster the economic growth in China. Now, moving on to another important event that can have significant impact on commodity markets, the geopolitical conflicts. Historically, geopolitical conflicts have had profound effects on commodity markets, leading to price volatility and supply chain disruptions. The Israel Iran conflict escalating in Q3 2024 risks disrupting energy supplies from the key oil producing region, driving potential volatility in oil prices and broader economic impacts. The Houthi attacks in the Red Sea also threaten critical shipping lanes, impacting global trade and raising freight costs, with implications for supply chains across multiple sectors. Now, as we approach 2025, these geopolitical events will likely remain critical factors influencing global markets, requiring strategic adjustments in the supply chain management and risk mitigations. Now, the possible outcomes of all of these events can have different impact on commodity prices. To understand this, we have categorized these outcomes into three scenarios: the low prices, base case, and high prices. In low price scenario, limited rate cuts would maintain higher borrowing costs, suppressing demand for commodities like metals and crude oil. Whereas with minimal fiscal support, China's GDP growth rate may slow down to 4.5%, leading to weaker industrial commodity consumption. A Trump clean sweep would heighten trade tensions, disrupting global supply chains and impacting commodity flows. A de escalation of conflicts would stabilize supply routes, reducing risk and encouraging predictable pricing in global commodity market. Under the base case scenario, we expect moderate rate cuts by the US Federal Reserve would support gradual economic recovery, supporting a stable growth for demand for commodities. Whereas a balanced fiscal support by Chinese government would maintain a steady growth rate of 4.8%, sustaining demand for key industrial inputs. A constrained Trump administration might balance protectionist measures with cooperation, reducing drastic trade disruptions. Limited escalations would mean manageable disruption, allowing for consistent global supply chains and stable commodity prices. In the optimistic scenario, looser monetary policy would boost economic activity, driving higher demand for crude oil and metals. Large scale stimulus packages would help China to achieve its economic growth target, leading to higher demand, particularly from the infrastructure and construction sectors, benefiting industrial metals. President Harris' administration would introduce green energy policies supporting growth in the renewable sectors and metals like copper and aluminium. Whereas severe escalations, especially in the Middle East, would likely disrupt oil supplies, driving up prices and increasing market volatility. Now, let's move forward to the detailed projections for metals and crude oils based on these scenarios. Over to you, Vivek.
Thanks, Anuj. Let's start with first understanding the importance of China for a base and precious metals market. China's economic slowdown significantly impacts the prices of metals due to its dominant role as a global consumer. China consumes around 50% of the global base metal output. The country's robust industrial and construction sectors drive demand for these materials, influencing global pricing dynamics. When China's economy is strong, the demand for metals typically rises, leading to higher prices. Conversely, during periods of economic slowdown, demand contracts significantly, resulting in lower prices. As you can see in the graph, China's GDP witnessed a slowdown during 2012 till 2016. Consequently, base metal price index also followed the trend and we saw an annual decline in the prices. Looking at the recent price trend, China's GDP is estimated to slow down to 4.6% on an annual basis as compared with 5.2% growth in 2023, resulting in a limited increase of just 1% in base metal prices. This trend underscores how fluctuations in China's economy impact the global metals by influencing supply and demand dynamics. Now, coming to precious metals, here as well, China's role as a major consumer is crucial. As one of the largest markets for metals like platinum and palladium, China's demand is closely tied to its economic performance and industrial activity. A slowdown in China's economy could reduce demand, particularly in sectors such as automotive and jewelry, which heavily utilizes platinum and palladium. Additionally, shift in government policies regarding precious metal price imports or new emission regulations can further impact market sentiments and prices. On your screen, you can see that automotive sales in China exhibit a positive correlation with precious metals like platinum and palladium. Now, let's take for example, in mid-2020, China's ministry implemented the China 6 emission standards for light and heavy duty vehicles. These regulations aim to substantially lower harmful emissions, including nitrogen oxides and particulate matter. As a consequence, the demand for platinum, a vital element in catalytic converters that mitigates harmful emissions, surged by more than 100% during 2020 and 2021, which leads to a 22.3% rise in platinum prices in the year 2021. Next, we will understand the impact of interest rates on the base metals. As you can see from the chart on left side, the interest rates and LME inventory levels exhibit a negative correlation due to the impact of interest rates on the cost of holding inventories. When interest rates are high, the cost of storing metal inventories increases, leading to lower inventory levels as it becomes more expensive to hold on to these assets. In contrast, when interest rates are low, the cost of storage decreases, hence incentivizing high inventory levels. Interest rates also impact the US dollar index, which ultimately affects the base metal prices. The dollar index and base metal prices typically exhibits an inverse relationship. As you can see in the chart on right side, that the base metal price index has a strong negative correlation of around 53% with the annual change in the US dollar index. So we can conclude that the monetary policy outcomes of major economies that impact interest rates and currency have a major influence on base metal market dynamics. Next, we will establish the relationship between the precious metals and the US dollar index. Gold and other precious metals have distinct relationship with the US dollar and the federal fund rate, characterized by strong negative correlation. Gold typically shows a negative correlation of around 75% with the US dollar index. When the dollar strengthens, gold price tends to fall as it becomes more expensive for international buyers, leading to decreased gold demand. Conversely, a weaker dollar often prompts increased investments in gold as a safe haven asset. Similarly, high interest rate elevate the opportunity cost of holding non-yielding assets like gold, making interest-bearing investments more attractive. This shift can lead to reduced demand for gold, further driving down its prices. Other precious metals such as silver and platinum also exhibit negative correlation with the dollar and interest rates, although to varying degree. Their prices are influenced by factors like industrial and economic conditions alongside currency fluctuations. To summarize, the monetary policy outcome of major economies play a crucial role in shaping the precious metal market dynamics. Now, let's take a closer look at the forecast for metals prices in the year 2025. Starting with the base metals, aluminum prices are forecast to increase 3.5% next year in 2025, driven by a supply deficit of 0.5 million tons, which is around 0.7% of the global production. Global aluminum production may increase at a slower rate of 1.6% next year, reaching 72.9 million tons, driven by a rise in supply from China. Whereas the global consumption will grow by around 2%, reaching 73.4 million tons, owing to an expected increase in demand for energy-efficient vehicles. Further, high feedstock alumina and upstream bauxite prices will continue to provide support to the aluminum prices in 2025. Moving on to copper, we expect prices to increase further in 2025 as the global copper market is expected to remain in a deficit. The global refined copper output will reach 28.7 million tons, which is around 1.6% rise from 2024 levels. This rise is majorly because of an expected increase in output from China, Indonesia, DRC, and India. On the other hand, the copper consumption will witness a growth of 2.7% to 28.8 million tons, driven by an increase in downstream demand, mainly from renewable energy and electric vehicle segment. Additionally, an anticipated decline in treatment and refining charges for smelters, driven by concerns about the availability of mined copper, will continue to pose risk to the copper supply next year. According to the Chile Copper Commission, the copper concentrate market is projected to remain in a deficit of 1.2 million tons, which is around 5% of the global mine supply in 2025. In zinc, prices are forecast to increase on an annual basis, driven by tight global zinc concentrate availability, along with a recovery in global zinc consumption. The global zinc mine output is forecast to inch up by just 1.8% next year, as compared with 4% growth expected in 2024, reflecting continued concerns regarding availability of mined output. Furthermore, global zinc consumption is projected to surge to around 14 million tons, driven by an increase in construction activities and rapid deployment of renewable energy infrastructure. Zinc's complementary role with steel as a key input for wind turbines, solar panel, and transmission towers, owing to its protective properties, will significantly support this growing demand. Lastly, in nickel, in base case scenario, the prices are anticipated to surge around 7% year over year in 2025. The main factor contributing to the rise is a decline in nickel market surplus. The nickel market surplus is projected to drop around 50% in 2025. The growth in demand is primarily driven by a recovery in downstream stainless steel sector demand, which accounts for around two-thirds of global nickel consumption. Now, let's look at the prices in the low and high range, which my colleague Anuj discussed at the start of the webinar. In the low range scenario, in aluminium, prices are projected to trade around 6% lower on average as compared with the base case, while copper prices will trade 6.5% lower than the base case scenario. In case of zinc, prices are projected to range between $2,500 to $2,800 per ton, while nickel prices are expected to remain around 12% below compared to the base case scenario. Conversely, in high range scenario, aluminum prices will likely range between $2,600 to $2,800 per ton, whereas the copper prices are projected to increase to $11,000 per ton, reflecting an increase of around 8% compared to the base case. Similarly, the average price of zinc and nickel are also expected to rise approximately $3,600 and $22,000 per ton respectively, both trading around 14 to 15% higher than the base case. Moving on to the precious metals outlook, we project precious metals excluding palladium prices to rise in 2025, driven by a persistent geopolitical risk, including escalations between Iran and Israel, the expanding Russia-Ukraine war, and the ongoing attacks by the Houthis in the Red Sea. All of them are expected to increase demand for precious metals next year. The Middle East, particularly the conflict between Iran and Israel, poses a risk to global energy market, prompting investors to turn to precious metals as a hedge against market volatility. The Houthis' attacks on shipping routes in the Red Sea threaten global supply chain, further reinforcing the attractiveness of gold as a safe haven asset. Moreover, weaker than expected US economic data, including slower job growth and lower than anticipated inflation, will likely lead to continued interest rate cut by the US Fed in 2025. This would weaken the dollar index and further support the upward movement in precious metal prices. In addition, continued increase in central bank gold purchases globally are expected to keep gold prices at a record high levels. As per the World Gold Council survey, around 81% of central banks are expected to increase their gold reserve in next 12 months, driven by persistent geopolitical tension. Additionally, deficit in the global silver market, driven by continued investments in renewable energy sector, will push silver prices upwards. The global silver market will remain in a deficit of around 0.25 million ounce, which is 25% of the global supply. In case of platinum, the market is also expected to witness a deficit of around 11% of the global supply in 2025, driven by continued supply concerns on account of closure of PGM mines by the producers globally due to adverse macroeconomic conditions. Platinum supply from North America may downtick around 16.5% year over year in 2025. On 12th of September, the Sibanye-Stillwater, a major PGM producer in South Africa, announced to cut its output by around 0.2 million ounce, which is around 4% of the global supply, with the Stillwater West mine being placed on care and maintenance and expansion spending deferred at East Boulder mine. Therefore, in our base case scenario, we forecast gold and silver prices to surge by around 23% and 14% annually in 2025 respectively, whereas the platinum prices will grow by around 4% year over year during the same period. However, palladium prices are expected to fall slightly on an annual basis in 2025 as the platinum market deficit may reduce to 0.3 million ounce in 2025. The global platinum supply is expected to improve 5%, whereas the global demand is expected to drop 1% on an annual basis in 2025. The slowdown in demand is majorly because of ongoing substitution of palladium with platinum in the automotive industry. In 2025, the substitution demand for palladium will surge to around 0.4 million ounce, which is 4% of the global palladium consumption by the end of 2025. Nevertheless, projections of interest rate cuts by the US Fed in 2025 will likely push down the US dollar index, which is expected to limit the downward movement in the palladium prices. Now, moving on to the scenario-based forecast, in a low-range scenario where geopolitical tensions might de-escalate and conflict is either avoided or resolved diplomatically, the pressure on precious metals would ease. Precious metal prices would likely trade 7 to 10% lower than the base case scenario, as investors' demand for safe haven assets diminishes with a more stable economic outlook. In a high range scenario, severe escalations between Iran and Israel is expected. Global precious metal prices are likely to see a significant surge. The heightened geopolitical instability will likely push the gold prices to around $3,000 per ounce, which is around 7% higher than our base case scenario. Silver, which often track gold price movement, is projected to surge by around 9% over the base case in this bullish outlook. Now, in case of PGM, both platinum and palladium prices are expected to trade around 10% higher on an average as compared with the base case, majorly tracking the gold price movement, as gold is a key driver in precious metal. Further, a better than expected recovery in China's economic activity could further boost industrial demands from PGMs. Moving on, my colleague Garvit will be taking you through the oil market. Over to you, Garvit.
Thank you, Vivek. Now let's see how these events could impact global crude oil market in 2025, starting with the economic slowdown in China. As the world's largest crude oil importer and the second largest consumer, China plays a pivotal role in shaping the oil market dynamics and is key to the demand side of the equation for the crude oil. Fluctuation in China's economic growth can have profound impact on global oil market and supply demand balances. As it is visible from the chart on the left hand side of your screen, historically there has been a clear relation between China's economic growth and oil prices. For instance, during the 2020, during 2008 and 9 period, a slowdown in China's economic activity, driven by a global financial crisis and a contraction in global trade, led to a substantial decline in oil prices. Similarly, in 2020, COVID-19 pandemic impacted China's GDP growth, leading to volatility in oil prices. Now shifting our focus to a more recent trend, indicators in China are pointing towards a slowdown in economic growth. For instance, China's economy grew 4.6% year over year in Q3, which is the weakest pace since the start of 2023. This is also reflected in country's oil intake, which declined approximately 2.8% year over year during the first 9 months of this year. Subsequently, led to a drop of approximately 8% in crude oil prices since the start of 2024. Now, if we examine the graph on the right, you can see the rate of growth for fuels consumption in China has been on a downtrend since the start of 2024, and even going forward in 2025, the growth rate is not the outlook does not appear very positive. While the rate of growth for fuel consumption is projected to recover from current levels, but it is expected to remain significantly below the historical trend. Now, we will examine the influence of geopolitical tension on crude oil prices. Geopolitical factors Geopolitical factors impact crude oil prices or market in general through various mechanisms, reflecting the interplay between supply, demand, and market sentiments. Conflicts or strained relation between countries, often arising from political, economic, or territorial disagreement, can create instability and uncertainty on global scale. When it comes to crude oil, geopolitical tension in the key oil producing regions like the Middle East, Russia, or Africa typically prompt market to react by anticipating a potential shortages, leading to a temporary rise in prices. The fear of reduced output or transportation disruption can drive prices higher even before any actual supply issue occurs. To understand this relation, we have examined Geopolitical Risk Index (GPR), an innovative tool that captures war threat, military buildup, terror threat, and escalation of war, etc. As you can see on your screen, some of the geopolitical events related to oil market are represented by the higher GPR value on the chart. Take, for example, the 1991 Gulf War, when Iraq invasion of Kuwait, both major players for oil market, led to a substantial spike in GPR index as well as oil prices during that period. A similar pattern occurred during the US-led invasion of Iraq in 2003 and the Arab Spring and civil war in Libya in 2011, when GPR index peaked and subsequently oil market reacted to the evolving geopolitical situation, establishing the impact of political instability on oil prices. More recently, the Russia Ukraine war caused another substantial peak in GPR index. As one of the world's largest crude oil exporter, Russia's conflict with Ukraine led to an immediate concern of supply cuts, resulting in an approx 33% rise in oil prices during Feb and March 2022. Even in 2023, with the Israel Hamas conflict, the GPR index once again reflected heightened geopolitical risk. While Israel is not a major player in oil market, the broader regional implication, especially the concerns around potential supply disruption from Iran, led to a rise in prices. Even today, concerns around direct assault on Iranian oil infrastructure by Israel or the risk of Iran blocking Strait of Hormuz, a crucial route for global oil transportation, kept the geopolitical risk elevated. In nutshell, we can say that geopolitical risks have constantly shown their ability to create volatility in oil prices. Now, let's shift our focus and see how interest rate cuts by US Federal Reserve can impact oil prices. US federal fund rates can impact crude oil prices in two ways. Firstly, through its direct influence on economic activities. If rates remain higher for an extended period, it can slow economic growth, leading to reduced industrial production and overall consumption, which ultimately dampens the oil demand. Conversely, a more accommodative policy stance can drive up energy consumption. As it is evident from the chart on the left hand side of your screen, Fed fund rates remain elevated during 2023 and 2024, which negatively impacted oil prices. Interest rate can also impact global oil market through its influence on US dollar index. As oil is globally traded in US dollar, any fluctuation in the value of dollar can impact oil prices. When Fed cut rates, the US dollar typically weakens, making oil less expensive for buyer using other currencies. This can increase demand for oil internationally, leading to an upward pressure on prices. Conversely, when the dollar strengthens, oil becomes more expensive for foreign buyer, which can suppress demand. This implies a negative correlation between the two, which is depicted in the chart on the right hand side of your screen. Overall, the changes in federal fund rates plays a crucial role in shaping economic conditions that affects oil demand. Up next, we will see how the upcoming US elections in November can influence global crude oil market. Uncertainty over the policy path in terms of oil drilling policies can cause price variance in the oil market. As we all know, Donald Trump has been aggressively pro fossil fuel, as evident during his presidency. Under his administration, the federal government leased more land for drilling, urged agency to waive environmental review, and loosen regulation in a way that could speed up pipeline construction and other energy infrastructure. And a recent statement by him, like drill, may lead to rise in oil rig counts and higher rate of growth for US crude oil production, similar to the trend visible from 2017 to 2019 period. On the other hand, Biden-Harris administration focused more on clean energy and climate change, issued several regulations targeting fossil fuel, and increased the royalty on companies paying for production on federal lands. It is anticipated that if the Democrat nominee Kamala Harris wins the election, she will likely follow the current energy policy path, supporting alternative and renewable production and consumption while reducing the fossil fuel uses. Moving on, after understanding how these events are related to oil market, an important question which comes to our mind is how we expect crude oil to trend over the next year. After witnessing a volatile 2024, we expect crude oil prices to drop in 2025. Our base case scenario is based on the assumption that there will be limited escalation in the Middle East and conflict remains largely rhetorical with no direct disruption to oil production or transportation route. Additionally, we expect moderate rate cut by US Federal Reserve along with moderate fiscal support in China. Therefore, in 2025, we expect crude oil prices to drop approximately 3 to 4% versus the average level expected in 2024. Key factors influencing the oil prices includes a gradual unwinding of OPEC plus voluntary production cut. Eight OPEC plus members are expected to gradually unwind voluntary production cuts of 2.2 million barrels per day during 2025, which may lead to rise in supply. Even projected rise in non-OPEC crude oil production, primarily driven by higher production in the US and Brazil, may support the downtrend. Non-OPEC crude oil production is projected to rise 2.4% year over year. Now coming to demand, a slow economic recovery in major economies like the US and China can negatively impact oil prices due to reduced energy demand. As industrial and consumer activity decline, demand for transportation and manufacturing decreases, while leading to an oversupply in the market. Global oil market is expected to remain in a surplus of 1.2 million barrels per day in 2025 versus a slight deficit in 2024. Given the uncertainty in the market, we at WNS Procurement use modeling estimate to gauge the impact on crude oil in higher as well as lower scenario. A severe escalation in the Middle East, a blockade of Strait of Hormuz, which accounts approximately 20% of global oil trade, or more aggressive rate cuts by major central bank could push oil prices up to our higher scenario, where prices might average close to $95 per barrel in 2025, which is approximately 20% above our base case forecast. However, if the tension in the Middle East de-escalate through diplomatic efforts, combined with restrictive rate cuts and limited additional fiscal support in China, and a clean sweep by Donald Trump, prices could decrease and align more closely to our lower scenario, which is depicted by the light green line on the chart. With this, we come to an end of our webinar and open the floor for questions. Over to you, Nishita.
Thank you so much, Garvit. So, like Garvit mentioned, we now open the floor for questions. Please post any questions in the Q&A box that you can see at the bottom of your screen. And as I can see, we already have a few questions. So the first question here, Anuj, is for you. So what are the assumptions for economic growth for major economies in 2025?
So we expect global GDP to remain at 3.1% in 2025. With the US economy, growth is expected to slow down to 1.8% compared to around 2.5% in 2024. And China is also expected to slow down in 2025, whereas the Eurozone GDP may witness an uptick in growth rate to around 1.3% in 2025.
Okay. Anuj, next question is also for you. How do you estimate that a full Republican victory may result in inflation and decline in growth if taxes are cut to fuel business growth while maintaining interest rates?
So while tax cuts can spur business activity, they don't necessarily resolve existing supply side issues like material shortages, labor market mismatch, or geopolitical risk. So if the demand grows faster than the ability of business to supply goods and services, the economy could experience a demand pull inflation, and the Republic administration may also favor the protectionist trade policies such as tariffs, and which can again raise the cost of imports, driving up the inflation. At the same time, these policy can disrupt the global trade flows, harming industries reliant on international supply chains, and which could curtail the growth.
Okay, thanks, Anuj. Next question, I guess it's for Vivek. And here, Vivek, the question is, what could be the possible impact on palladium prices if G7 countries announce any sanctions on Russian palladium?
So if G7 countries announces any sanctions, then this would likely create a huge supply gap in the palladium market, considering Russia as a largest palladium producer, accounting for more than 40% in the global supply. So we are expecting that after imposing sanctions, market will become highly volatile and prices could increase by more than 20% on an intraday basis. This is a key event that is likely to watch out for in the few days.
Okay, thanks, Vivek. That's really insightful. Next question, Anuj, if you could answer. So, how will these global economic conditions that we discussed about, these can have an impact on the steel prices?
Um, so we currently don't have a detailed, analysis of forecast and impact of all of these events on the steel market. However, these events, particularly, the protectionist and how the Chinese economy, behave in the coming years will definitely define, the price trajectory of the steel prices, right? So currently, the steel market is in the oversupply situation. Prices in all the regions have been declining continuously for the last 10 to 12 months, and if the China's economy doesn't pick up, then it will have a huge impact, on the steel prices going forward as well. Whereas uh, Harris administration, can lead to green initiatives, which can also lead to a rise in demand for the steel in the US.
Okay, thanks, Anuj. So, next question we have is on crude oil. So, that's for you, Garvit. If there's a clean Trump or Republican win and his desire to open up US drilling of oil, how will that impact the oil prices? I think we have covered this, but if you could briefly, summarize this.
Sure. So a clean win by Donald Trump or a Republican era, it will lead to a higher oil rig counts, and as US is one of the major oil players, more drilling could lead to increase in US domestic production, and this will lead to an overall like more supply in the market, and which could put downward pressure on prices. Even the anticipation of increased drilling might boost the market sentiment among investor and producer, potentially leading to price fluctuations and a decline in prices, as there will be a more oil, and that we have already covered. Yes.
Okay, got it. And everyone, we have like 5 minutes left in our session. So while we are answering the questions that are already there, but if you have any other questions, please feel free to post in the Q&A section. And Garvit, I guess the next question is also for you. Given the varying approaches to the foreign policy under different US administrations, how do you foresee potential shifts in US sanctions on key oil producing nations like Iran, Venezuela, and Russia?
Okay, sure. So, Trump presidency in 2025 could lead to restrictive sanction on Iran, could lead to stricter sanctions on Iran while potentially easing sanction on Russia for a peace deal. Trump might unveil the maximum pressure approach, reversing recent production gains by Iran. In contrary, Harris presidency would likely maintain the Biden administration stance, keeping Iranian oil on the market but intensified sanction on Russia. The approach to Venezuelan oil market remain uncertain, while the possible new strategy depending on the evolving political condition domestically in Venezuela.
Okay, thanks, Garvit. Next question is on platinum. So, Vivek, here, given the growing focus on decarbonization and the role of platinum in hydrogen production and fuel cells, how do you anticipate platinum prices to respond to increased investment in green energy technologies?
Okay, so the growing focus on decarbonization and increased investments in green energy technologies, particularly hydrogen production and fuel cells, are expected to have a positive impact on the palladium demand, thereby on palladium prices. As green hydrogen production scale up, driven by policy support and government funding, demand for platinum is expected to rise significantly in the next decade, especially from the hydrogen related appliances such as fuel cell electric vehicles. According to the World Platinum Investment Council, the platinum demand from these sectors is forecast to grow from just 40,000 ounce in 2023 to around 476,000 ounce by the end of 2028.
Okay, Thanks, Vivek, for that. And we have like a similar question regarding oil as well. So, Garvit, if you could answer this, with China's rapid transition towards electric vehicles and its focus on green energy, how do you anticipate this shift affecting countries' long-term crude oil demand?
Definitely, a rapid shift towards electric vehicles in China is likely to reduce the country's long term demand for crude oil, particularly in the transportation sector, which currently accounts for a significant portion of oil consumption. China is pushing aggressively for EV adoption and LNG based trucks. Even EV penetration is expected to exceed the government target this year and expected to reach around 40%. As we have seen that it has already reached 40% of the new car sales in this year, which is 29% above the 2023 levels. Uh, Even China's CNG powered truck fleet is expected to grow. Even in 2024, it has displaced approximately 300,000 barrels per day for diesel.
Okay. So, I guess we just have 1 minute left for our session, and this is our last question, and that's for you, Anuj. What would be the impact of protectionism trade policies by the US on global economy?
So if the trade protectionist policies are adopted by the US, so it could have result in significant lower growth in the global economy, particularly with the US trading partners, in China, Korea, Vietnam, and also to the Eurozone if they are not able to, agree on a free trade agreement, and it can, lead to a GDP growth below the 1% of the current baseline.
Okay, that's really insightful. Thanks, Anuj. We have just 1 minute left. If anyone else has any other questions, we have answered all which were posted in our Q&A section. Okay, I think that's all the questions that we have for today's session. And with this, everyone, we come to the end of our webinar today. Thank you, everyone, for joining us today. Hope you found this session insightful. Thank you so much. Have a great day ahead.